The stock market crash alarm, 8 red flags you can't ignore. The whispers are growing louder, a stock market crash is looming. Experts are sounding the alarm, but the question on everyone's mind is when it will strike. With global tensions, political uncertainties, and economic wobbles, the stage seems set for turmoil. But here's where it gets controversial. While many agree a crash is coming, others argue the economy's resilience could delay the inevitable. So, what's the truth? And more importantly, what can you do to protect yourself? Let's dive into the 8 warning signs experts are watching, and why they matter more than ever. 1. The yield curve, a telltale sign of trouble. The yield curve is like a financial weather vane, and right now, it's pointing towards stormy skies, at least in some parts of the world. Normally, long-term bonds pay higher interest because they're riskier. But when the yield curve inverts, meaning short-term bonds pay more, it's a red flag. Historically, this has predicted recessions with eerie accuracy. And this is the part most people miss. While the US yield curve has been inverted for months, the UK's remains normal. Does this mean the UK is safer? Or is it just a matter of time? 2. Rising unemployment, the silent alarm. When companies start cutting jobs, it's a clear sign of trouble. Unemployment rates are creeping up in some regions, but the data is murky thanks to post-pandemic distortions. Here's the kicker, even if jobless claims aren't spiking dramatically, a stagnant jobs market could still signal an economy on shaky ground. Are we overlooking a slow-burning crisis? 3. PMIs, the pulse of the economy. Purchasing Managers' Indexes, PMIs, are like a monthly checkup for the economy. Scores above 50 mean growth, below 50 spells contraction. The UK's composite PMI is teetering at 50.1, while the US holds steady at 53.9 for now. But manufacturing PMIs are already in decline. The question is, how long until the rest of the economy follows suit? 4. Economic Surprise Index, are we too optimistic? This index measures whether economic results beat or miss expectations. Right now, it's positive globally, but that could be a double-edged sword. Here's the twist. A persistently high surprise index might mean we're overestimating economic strength. What happens when reality catches up? 5. Government deficits, the ticking time bomb. Governments spending more than they earn. Nothing new. But when deficits hit 3 to 5% of GDP, it's a warning sign. The UK's deficit is already at 5.3% and it's rising. The controversial take, some argue governments should spend more to stimulate growth, while others say it's a recipe for disaster. Who's right? 6. Government debt costs, the hidden danger. The cost of servicing government debt is climbing, especially with rising interest rates. The UK's 10-year gilt yield is hovering around 4.4%, but it's the speed of the rise that's alarming. The counterpoint, some experts say markets have already priced in higher yields, so there's no need to panic. Are they being too complacent? 7. Company results, cracks in the foundation. Earnings downgrades, missed forecasts, and dividend cuts are like canaries in the coal mine. When companies start tightening their belts, it's a sign they're bracing for impact. The overlooked detail, dividend cuts often precede recessions, but so far, payouts remain stable. Is this the calm before the storm? 8. Investor sentiment, the wild card. Bullish investors drive markets up, but when optimism turns to pessimism, the bubble bursts. Right now, sentiment is frothy, with speculative investments like meme stocks and cryptocurrencies soaring. The provocative question, are we in a bubble, or is this just the new normal? What should you do now? Timing the market is a fool's game, but ignoring these warning signs is riskier. Diversify your portfolio, keep an eye on global trends, and don't let fear drive your decisions. But here's the real question, are you prepared for what's coming? And if not, what's your plan? Let's spark a debate. Do you think a crash is imminent, or is the economy stronger than the doomsayers believe? Share your thoughts in the comments, I'd love to hear your take.